All right, what's going on, guys? How are we all? Good evening. Thanks for joining me this Wednesday evening. I wanted to do this live again just to interact with people and just have conversations, really. I know that there are already some people in here with questions already there and ready to go. So what I think we'll do is we'll spend maybe about an hour or so and just get through as many questions as we possibly can. I know that there's a lot of stuff in the news right now around the markets. There's a lot of volatility going on right now. There is a big day in the States tomorrow. They need to get the budget approved so that the government doesn't shut down. They have really left it until the very, very last minute. So tomorrow is going to be very, 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 very interesting indeed. And that speaks to wider issues and wider juxtaposing and kind of negotiations going on in the States right now as well. So watch this space tomorrow for the markets and see what actually happens. It's anybody's guess, really, to be honest. I would imagine that they will do what is necessary so the government doesn't shut down. Because if the government does shut down, that basically means they will start to default on their commitments. And I can't remember in living memory when the United States have ever done that. So I doubt very much that they're going to allow that to happen. But let's just put it this way. It is down to the wire, which it will be interesting to see what happens with the markets tomorrow morning and throughout tomorrow, as we go to the Senate and the House to see what happens and what the outcomes are. So yeah, but like I said, guys, this market volatility that we're seeing right now should be part of what you would expect as investors in the stock market. If you're investing for the long term, it really shouldn't be an issue, really. But I know that it can be very, very difficult to try to control that inner protective mechanism that we all have. It is just like that, but just be mindful that this volatility is likely to continue as well. Right, so let me just get to what we already have in the questions right here, because some of the questions went in early. I can't get them up on the screen, so I'm just going to see where I'm at first and foremost, and then we can get to it. Okay, there's a question here from David Hughes. So David is asking, hi Pete, can I ask about ISAs, an area I've always found confusing? If your allowance is 20K, but you have stocks and shares ISAs, what happens if your gains take you well over the 20K? Your 20K allowance is only applicable to your contribution. So in the example that you're giving here, if you contribute 20K and then like your gains take you up to 40K, it doesn't matter. You've only contributed £20,000. So therefore, any gains that you get are still completely tax-free. They do not count towards your contributions into your ISA. So you'll be completely fine in terms of exceeding the limits you wouldn't have, because the limit is simply on the amount of money that you can contribute into your ISA, i.e. pay into your ISA. So in this example, you'll be completely fine. There's a follow-up here also from David. It said, also ISAs, what is the tax benefit on it, on the capital or the gains or both? It's all very confusing. So your ISAs are completely tax-free. They are free from capital gains tax, free from income tax. So basically, it's completely tax-free. You don't have to worry about paying tax on any of it at all. So yeah, just remember that when it comes to the ISAs. Hope that clears that up. Bear me 1 second. I'm just looking at my picture quality on here. Not necessarily happy with what I'm seeing. So let me just see if I can, if there's anything I can do to tweak it on my settings here. Bear me 1 second, guys. Yeah, that's as high as it's going to go. Okay, hopefully that will get better. Right, okay, so there is a question here from Stephen H. Is it fair to say that the next crash could last longer than usual because of how overvalued the stock markets are? Not necessarily, no. For a market crash to happen, it's not necessarily because of prices or assets being overvalued, that doesn't necessarily cause a market crash in any way, and it doesn't mean that it's going to last longer either. You have to look at the underlying reasons why a market crash will happen. So back in 2007, 2008, it was a systemic problem. It was banks being irresponsible with their lending criteria and lending their money to, all kinds of people, and not paying enough due diligence to the quality of business they were doing. This time round, yes, you're going to have asset prices that were high, but back in 2008, asset prices were high relative to the times. We've just happened to reach a new high. Back in 2007, 2008, the markets were had never been anywhere near where they are. So we're just on a onward trajectory of the markets basically increasing over time. In 10 years' time, 15 years' time, we'll probably see the markets go even higher than they are right now, potentially. So I don't think that the market correction would last any longer just because of that. I think the underlying cause for the crash will be the problem. You can talk about the debt problems. You can talk about all kinds of stuff that could feed into it. Inflationary problems, all this kind of stuff. Whether it will last longer, we don't know. The last one took 5 years. The next one may take three years. It might take 2 years, 7 years, 10 years. We don't know. But I don't believe it will be because of asset prices or share prices being so high. Right, let me just find myself. Okay, I think I'm now with ones that I can actually put on the screen. Where are we? Okay, cool. Right, so this is from Kev. Hey Pete, would someone, me, invest in a limited company, or might a limited company might as well be private because I don't understand what you mean by that, Kev. What do you mean? How would someone invest in a limited company, or might a limited company might as well be private because I don't know what you mean by that, mate. You can't invest in a limited company on the stock market, really, because most of the companies on the stock market are publicly traded companies. So if you're looking to invest in a limited company, you're looking to invest in a small business that may be local to you. That's not the same as investing in the stock market. Abdul, I'm really, really well. Thank you, mate. Appreciate you asking. Right, let's have a look at this. 0161, Manny. Okay. Silly question, but when do you normally add a hedge to your portfolio? Are there any 24/7, or do you usually add them only at a time of uncertainty or recession? You'll probably you normally hedge in trading. I don't trade. So that is a trading question specifically. If typically you're invested in a portfolio for the long term, you buy companies that you feel fit your objective, your goal at the outset of your investment strategy. You don't necessarily positions. Now you could technically argue that you could hedge your positions in a portfolio by saying, right, you might have an interest in a particular sector. I'm going to use EV for this. And you might say, okay, we know that Tesla is the biggest EV company on the planet, so I'm going to buy a little bit of Tesla. But you then might start to have a look at, right, there is a lot of competition in that space, and you may want to get the benefit of investing in another incumbent company or a competitor to Tesla that offers great opportunities potentially for growth. So you may, for example, and I'm just making this up, you may, for example, say, okay, I believe NIO is that company. And when you start to broaden out your research on the competitors, then you might say, okay, so there's NIO, who's the next company who is like NIO on the same trajectory that could potentially compete with Tesla. Because the idea is that if NIO doesn't do well, you would hope that this second company does well. So you could say, for example, and I'm going to pull a company out the air, Volkswagen, for example, right? You may say, okay, there's Volkswagen in that space as well. And I think that those NIO and Volkswagen will be the biggest competitors to Tesla. You might hedge in a portfolio by saying, right, I've got a holding in Tesla, but what I'm going to do is I'm going to take a position in NIO, and to further hedge my position, because hedging is all about giving yourself the other side. You're giving yourself a counterweight. So you might say, okay, I'm going to take a position in Volkswagen under the assumption that if NIO doesn't do well, and Volkswagen does better than NIO, then you're going to get that benefit of that growth as well. That's how you might hedge in a portfolio. But typically when you're hedging, it's typically something that you would do when you're trading. So, for example, you might say for argument's sake, Tesla. I want to take a trade on Tesla today because I believe that the share price is going to go up by 15, 20% because there may be, I don't know, earnings. Q4 earnings, for example, you think that it's going to go up, and you may hedge your position the opposite direction by taking the short position, saying, well, actually, if it doesn't go up 15%, it might fall 5 or 10%. You take the opposite side of that trade, but you would do that under trading using CFDs, so on and so forth. That's not what I tend to do with my investment portfolio. So it's not something that I can really guide people on, but that's typically how it will work if you wanted to take out a hedge on a trading position. I've given an example of how that will work from an investment portfolio. But again, in an investment portfolio, you're taking the long-term view. You're not taking a short-term trade position in order to realize a very quick return. GT Playboy, how you doing? Good evening, Pete. Hope you're well. Loving all the content. Thank you, mate. Really do appreciate it. There's a bit of comments around here along the lines of money printing, QE. I mean, if you guys have not listened to the podcast where Gary Stevenson was talking about the whole QE situation, I've been following up on some of the news today, and people like Ray Dalio were saying that actually there's going to be more and more and more QE coming along, and we are going to be seeing that for the next at least 2-3 years, as you know, the markets are going to need to be continually propped up. It's going to be a very, very interesting position to see what actually happens. But yeah. I like this name. I think this is Nigerian, I think. Right? Let me know if you do. Olutundan. Okay, hi Pete. I'm looking at some index funds on Vanguard, but most are captured in the life strategy funds. What do you advise? Get this life strategy or individual index funds? It's hard for me to say without knowing kind of what your goals are, the reason why you're picking them. I think the only thing that you should bear in mind is with the life strategy funds, you're going to have, unless you're going for the 100% life strategy fund, you are going to have an element of bonds in there to give you some counterbalance for the risk, because the life strategy funds are risk rated portfolios. Versus if you go for the index fund purely, you're not going to have any bond allocation to help you offset your risk. So that's maybe something to consider, to be mindful of. But I mean, it really depends on whether or not I've got so many questions in my head that if we were doing coaching, I would be asking you these questions to get to the bottom of it. And it's hard to do it because it's only a question I can't interact with you directly. So the first thing would be, okay, what level of risk are you willing to take? That's the most important thing. Okay. Then we can start talking about, diversification and stuff like that. Most of the life strategy funds are very well diversified, but you still have that bond element in there. So without knowing really what your goals are and why you were looking at the life strategy fund specifically, it's hard for me to say, go for this one over that one. I guess the question you need to ask yourself is, if you're going for the 100% life strategy fund, for example, which doesn't have the bond element to it, and you're looking at a number of index funds, you can get them all in one place, then you might as well just go for the life strategy. But if you are going for maybe like the 60-40 life strategy fund and you need the bond equity in there, just go with the life strategy. But with individual index funds, you got to remember Vanguard have basically packaged that life strategy fund, whichever one you go for, at their own, by their own research and based on a particular ethos. You won't be able to do that if you package them yourself. So if you're not confident in your own selection, stick with the life strategy one. If you're confident in your selection, then maybe go for the individual index funds yourself and try and package them together, but maybe trust the professionals. But again, it's really, really hard for me to give you a concrete answer without really being able to ask you questions back and forth. The risk element, though, is really, really important. You just have to remember that markets are volatile right now, so you might decide that you want to have a little bit of protection when it comes to the bond allocation to it as well. So yeah. All right. Where were we? Jay. Surprised to find out that UK bank stocks are very cheap in their value. Any thoughts on why? Been eyeing up HSBC, but bank stocks have been cheap really since 2007, 2008. Is because they have been riddled with scandal after scandal, fine after fine, and the banks aren't what they used to be. They just aren't. The big banks aren't. They shrunk down a lot of their investment activities after the last financial crash, and that was something that they were mandated to do by the FCA. And most of the banks made most of their profits from their investment activity. So when they shrunk down their investment activity or trading activities, essentially meant that they weren't going to make as much money. Therefore, you saw that impact on it as well. But the banks have been, riddled with a lot of scandals. I mean, you just look at the PPI stuff that felt like it wasn't going to end. These banks got absolutely clobbered with that, and a lot of them didn't start turning profit again after being bailed out, particularly RBS for many years after 2007, 2008. So, do have a look at the banks carefully. If you're looking at HSBC, do have a look at them carefully and make sure you're doing your research before you get into them. That isn't to say don't go get them. Just go make sure you're doing your research. Do you think the American markets will affect the English markets at the moment? My English shares are doing well, but American ones aren't. Well, there's a phrase in the industry saying that if America sneezes, the whole world catches a cold. If the American markets take a bit of a tumble, you can bet your bottom dollar that it's going to be felt elsewhere, including here in the UK. So it is one of those situations where we obviously talk about diversification and diversification being key, because whilst it might and it will impact the UK markets and probably European markets and most of the other markets, developed, efficient markets, you need to have your eggs spread across a number of different baskets, i.e. have it all diversified so that you're not just in one specific territory. Diversification is real, but yeah, I do think that if the American markets do take a bit of a tumble or correction or a crash, we will feel it, because a lot of the time the efficient markets are connected. We're just going to feel it. We will. And the American market is the biggest market in the world as well. So, it's impossible for it not to be, for your investments not to be affected by it. Hey Pete, what do you think of the FTSE All World ETF / index funds? They're good. They're good. They're fully all world global diversification, basically invested in a good range of companies that would have been well researched. So, the index funds and ETFs, again, those are Vanguard ones. Vanguard will do their work, will do what they need to in order to make sure that that there is good research that goes into the selection. So, yeah. Sorry, I know that United are playing Villarreal, and I think there's just been an equaliser by Alex Telles. Oh dear. Nervous days, even with Ronaldo in the team. What can I say? Oh my God. Abdul, if I had 50k cash, would you invest in ETFs, index funds, or would you use the money to purchase a buy-to-let property? 50k would be a deposit for a mortgage, aiming for 8% net yield. Mate, it will be completely up to you. I can't tell you what to do with that. Property and markets, ETFs, they have their own benefits. You have to do what you feel is right for you. That I can't tell you, go and do one of those. What I would do is very, very different to what you should definitely do. So I guess for you, what you should be doing is looking at the pros and cons of both. So the pros of the market are it's very, very liquid. You can get your money out. You can put, a good portion of that 50k into a tax efficient ISA. So you'll get all of the growth within that 20k allocation completely free. The disadvantage is, markets are very, very volatile, and there might be a correction down the road or a crash down the road. We just don't know if that is true or not. So you have to contend with the investment risk that you're going to have there. The pros of a property is that it's a physical asset. As long as you have a tenant in there, then your 8% net yield is pretty much nailed on. And as long as you don't see any property market crashes, then the property of the value of that property should increase over time. Those are the pros and cons. Based on that, you should be then deciding which one you feel is the best route for you to go down. You got to think, well, 50K, there are bigger points that I would probably point out, but for you, I don't think that you need to worry. Inheritance tax, all that kind of stuff, you probably won't need to worry about that. Tax efficiency, property isn't as tax efficient as investments, because you still have to pay tax on your rental income. So it's not as tax efficient in property. That's a con, but you have to weigh up the pros and cons, mate, to decide what you think is going to be best for you. What bonds do you buy to diversify? It depends on who you're looking at, but they will have a load of bonds available, and they will have them by regions. They'll have US bonds, treasury bonds. They'll have UK bonds, corporate bonds, gilts. There will be bonds that you can buy for other parts of the world as well. It really depends on how you want to diversify. If you're invested in a global fund, then you may want to have a look at global bonds, where you're going to have a little bit of exposure to different territories. And also just make sure you understand the difference between corporate bonds and government bonds, so gilts, essentially, because what you get and how they are designed to work are slightly different. Government bonds are slightly more secure than corporate bonds, because obviously governments, it's very, very rare that they default on their debt, whereas companies might. Although if you look at the likes of maybe companies like Apple, who are big bond issuers, they're a AAA credit rated company, so they will be classed as an investment grade bond. You want to avoid junk bonds, although if you go into places like Vanguard and some of the big investment house providers, they will have portfolios with a mixture of junk bonds and investment grade bonds. So junk bonds are companies that aren't the Apples of this world with a AAA credit rating because they've got loads of money in the bank and they always pay back their debts. They may be companies that don't have such a strong financial footing, and therefore the risk is a little bit higher. Typically with those companies, you'll find that they'll pay you a little bit more in interest returns, so a coupon or a rate, but you're taking that extra risk because they could not fulfill their repayment. So it's really important. Make sure you understand the bonds and how they actually work. But global could be good, but you will get to choose, depending if you're using someone like Vanguard, you'll get to choose territories. But global, just like the equity markets, is always a good way of actually spreading your risk. Again, it's worthwhile just bearing in mind that if you are buying bonds with the likes of Vanguard and them, then the bond values will still go up and down because it is an investment bond. Essentially, you could go and go to the high street potentially and go and get fixed rate bonds. Those will pretty much carry no investment risk at all, but those interest rates, the returns that you're going to get are going to be very, very low. You'll probably be lucky if you get one for 1.5–2% these days. Yeah, and McKnight has just said there that government bonds are usually safer than corporate bonds. Okay, what I meant was, how would a normal person invest in a limited company if possible? You can't invest in limited companies, mate. You would have to know the directors of the business, the owners of the business, and see if they want to invest they want investors in their business. Otherwise, even if you go into people like crowdfunding, you may not necessarily get a share of a limited company. Why would you want to invest in a limited company anyway? That would be the big question. Most limited companies are owned by individuals, and for them to take on investors, you would need to bring value to the business a lot of the time greater than money. So expertise, so on and so forth. Limited companies aren't traded publicly. They're not going to be on, the foot in the London Stock Exchange or the New York Stock Exchange. So I don't see why you'd want to invest in a limited company. Hey, John, what do you think about the drop in American markets? Is it worth buying more shares in a good company whilst it's down? Yes, I mean, buying the dip is always good. Just make sure, as always, that you are fully aware, number one, that if you go and buy the dip, that might not be the bottom of the dip. So it could still continue to go down. But if you're investing over the long term, the pound cost averaging effects could be quite powerful, because if in a falling market, if you're investing on the monthly basis, essentially what you're getting is the ability to pick up shares at a discounted rate every single month. And once the market starts to recover, that's where you're going to really get that compounding effect, and you're going to see the benefit of that pound cost averaging or dollar cost averaging in there. So yeah, you can buy the dip. It would be a good idea to buy the dip. People say buy the dip, and that's what professional investors like Warren will be doing. But you have to understand that just because you bought it at what you feel is the bottom, it may not be the bottom. It may continue to slide. So there's still risk there. And obviously just make sure that you're aware of the companies that you're buying. If you're buying, the dividend aristocrats, they're probably going to be slightly less impacted by the level of volatility and market fluctuations. But this is the risk that you take when you're investing. All right, guys, there are 53 people on here. Let's get those likes up to 20, please, if you can. That will be fantastic. Let's see where we are. Let me just refresh this, actually. Oh, that's better. Okay. Are some investment bankers not allowed to invest personally, i.e. with trading 212 accounts? It's not just investment bankers. There are like even accountants sometimes, and solicitors sometimes. They're not allowed to invest without permission from their companies because of insider trading, insider knowledge, that kind of stuff. So there will be certain rules that they have to, there are a certain procedure that they will have to follow. There's something that we call the walled garden, which is for solicitors, accountants, where they will have a set of pre-approved investments or investment vehicles, funds that they can actually invest in because of their profession, and it is because of insider trading and fears of that. So yeah, some of them will have to go through certain processes just to make sure that they're adhering to policy, because investment bankers, as you will imagine, they will have access to a lot of market sensitive data. So what they don't want is an investment banker picking up an investment tip and then investing a load of his personal money before it's actually public knowledge. That's illegal. They're not allowed to do that. So yeah, there will be a process that most of them have to adhere to. Okay, I've been offered to invest in Plum crowdfunding round. What are your views on this? Fabulous channel, by the way. Thank you. Make sure you read the fine print and make sure you understand what the crowdfunding is actually offering you, and make sure you read the fine print. I said that twice because you have to make sure you read the fine print. There you go. It's a third time. The questions you will need to ask is, are there any clauses around how you get your money back? Because, for example, with the Money Box one, when they did a bit of crowdfunding last year, you couldn't get your money out, and you would only get your money out if you were invested in that round if they either sold the business or went and floated on the stock market. Beyond that, you don't get anything back. So you need to know the fine print. So yeah, just pay attention to the detail and then ask yourself that whether that's something that you're willing to put your money to. And just do remember, don't let the allure or the idea of making a shed load of returns because you've been classed as one of these lucky people to be invested in this round of investment, this opportunity, cloud the logical part of your brain that should be analyzing the risk and allowing you to make a rational decision. Okay, so don't let the reward shadow out your train of thought. You need to be very, very pragmatic and clear. Portfolio 100% in index ETFs. Index ETFs, but how can I hedge against equities altogether? I'm diversified across 6 regional ETFs, but when do I buy gold or bonds? Well, when you buy gold and bonds, it's completely down to you, mate. I mean, look, if you're worried that you're holding too much in equities, then you probably should have gold or bonds in your portfolio already, really. So this is the thing, right? If you're 100% in, I've spoken about this on maybe not the live from last week, the one before that. There are a lot of people who've invested over the last 12 to 18 months who will be looking at their portfolio right now, who may be paying attention to news right now, who will be absolutely panicking and be a little bit worried about what they've actually invested in. And the reason for that is because through no fault of their own, they've basically gone gung-ho into something without really understanding the steps that should have been taken at the very, very, very beginning. When you first start out to invest, the first thing you should be asking yourself, and at least trying to analyze, is what is my downside risk? Over the last 12 to 18 months, it's all been about how much money can I make? So we're looking at the reward. We're not looking at the risk. That's not investing. Investing is about mitigating your downside for the benefit of an upside. So you're looking at your risk first. Risk management is really, really important. So if you're the kind of investor where you are 100% in equities and you're looking at the news and you're thinking, shit, then that tells me straight off the bat that maybe you've skipped the whole risk management. How do I protect myself from potential downturns at the very, very beginning? So if you're worried right now and questioning when should I be hedged or when should I be hedging my investment, the answer is you probably should have hedged right from the beginning if that's the question you're asking yourself right now. So in terms of bonds, yes, you can use gold because that is obviously a store of value and it has been used to diversify portfolio for years and years and years. You probably should have done it yesterday, mate. If you're worried, you probably should have done it yesterday. So, have a look at your portfolio and just see where you are and decide how you're going to divide that up. It's hard for me to comment on this because I have no idea where you are on the risk spectrum and I have no idea how long you're looking to invest for. And again, this is the kind of stuff that I do in coaching to understand where you are. Then we talk about your investment time horizon, and then we talk about, right, what risk can you potentially afford to take on the scale that then informs, okay, what percentage of your portfolio should you have in bonds or should you have in gold to help you offset the equity risk that you have? But I don't know the answer to that question, and I can't run you through the scientific questionnaire because we can't interact in this medium. But in short answer, mate, if you're worried that you've got 100% equities right now and you're asking when you should be hedged, then you probably should have been hedged yesterday. So definitely have a look at some bonds and how you're going to go about, diversifying and hedging that risk within your portfolio, because risk management is really important. Yeah, unfortunately, mate, I'm sorry. I can't do anything about that, unfortunately. I can see it on my screen right here, but unless I would have to stop the stream altogether. So you're going to have to bear with me. Unfortunately, there's nothing I can do with it. What do you think of fact in ISA? What do you mean by that? Can you elaborate, please, Roy? Will you have a video tomorrow evening in response to tomorrow's US markets? Probably not. I've got a pretty stacked out day tomorrow. I've got a lot going on at the moment, so probably not. But I will try and provide commentary on it in another medium if I get the chance to. Making videos are a lengthy process. So I'll try to, but it won't be tomorrow. Can you have a VCT and an ISA? No, you can't. Pete, I'm looking at the iShares Core FTSE 100 ETF. Would you say it's a good ETF to get? It's the FTSE 100. So it's UK. It's UK's top 100 company. So there are big companies in there that will have international income as well. So it is a good ETF. Does it match you though? I don't know, because you have to think about the risk that you're taking as well. Make sure you're paying attention to what the actual ETF is designed to do, what its aim is to do, and you need to also need to make sure that you're looking at where it actually fits on the risk scale as well. Andy, evening P, should we be holding some money back each month to invest when the crash happens, or carry on investing the full amount each month? If you're already investing, mate, just keep on investing. When's the crash going to happen? If you can answer me that tells me that maybe you should hold some money back. But if you can't answer that question, just carry on as usual. You know, we're waiting for a crash that we don't know. It might happen it might happen tomorrow. It might happen next week. It might be happening right now and then just bounce out immediately on a recovery. We have no idea what's going to happen. You cannot anticipate the market. You can't time it. So don't even bother with it. Just put the money that you've got going in already into the markets, and what happens will happen. If the market crashes, you'll still be investing when the market crashes. So it doesn't make any difference at all, but it's impossible to time. So if you're already putting money in, just continue to put money in. Evening, how you doing? No problem, mate. Not a problem at all. Sorry, I just had a notification up. It's still 1-1. Look, it's so frustrating. It really, really is. And I just can't bear to watch, even with Ronaldo in the team. How can we be 1-1? It is absolutely unreal. But I digress. It's so frustrating. What is more likely to fall if a UK if any a UK bond or a US government bond? Good question. They're both really, really strong creditors. I would say they're probably about equal. I cannot see the UK ever defaulting on a bond. They never have. I don't think they ever will. The same thing with the US. So I think they're just about equal. The chances of them both defaulting are very, 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 very slim. Very, very slim. And if they do, there is something really, 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 really wrong, and everybody should be scared. I thought so. I think that's a Yoruba name, right? Which index fund do you recommend? I can't recommend an index fund because I don't know your situation, mate. I don't know what your investment goals are. I don't know how long you're looking to invest for. I don't know whether you should be investing or shouldn't be investing. So I can't recommend any index funds, unfortunately. If I took part in the Plum crowdfunding, say around £200, what do I stand to gain? They're predicting 3 times growth. Great channel, Pete. Mate, I don't know. Unless I see the actual crowdfunding offering, there's no way that I can even begin to explain what your potential benefits could be. It's an impossible question to ask without me seeing the details. What do you think about Rishi's green bonds? I have heard about this, but I've not paid that much attention to it, so I can't give any comment on that at this point in time. I've not looked into any detail, mate. How much is trading 212 allowed for a typical spread? They range between 5 to 40 bips on my larger trades. Mate, they get to set their own rates. Unfortunately, they're a business, so they get to dictate what spreads they want to take. It's just the way it is, mate. It's like me running a business, and then I set my prices for what I feel my service warrants. The same thing applies with them, mate. They get to set their spreads. There isn't a typical spread or an amount that they have to charge people because they're pretty much their own business. So they get to set their own rates. Only last because limited companies, because there's a front pocket wallet company which I use. What I know will explode in the coming years, and I wanted to get involved. So if they're a limited company, unless you know the company directors and you're able to, if you're a retail investor, they're not going to take your money, mate. Unless you've got a large bit of capital and you can add something to the business, they won't take retail money. Limited companies don't operate in that way. Limited companies are owned by individuals or a group of individuals. If they're going through investments, they will normally go through business angels or investment angels. They will not take money from just general public unless they're crowdfunding. And then that doesn't mean that you're going to get a share of the business either. I'm new to investing. Do you recommend a good platform to start? Yes, Mark. It really depends on how you wanted to start investing and what you've already started to research. Because if you're looking to invest in individual stocks yourself, that is high risk, but that would mean that you would go for a certain type of provider. So the likes of, well, you can't use trading 212 anymore because they don't have any accounts, but the likes of, for individual stocks anyway, you would have a look at Stake, Free Trade, Orca. You can use Etoro as well for individual stocks. So those are 4 right there. If you want to buy ETFs, index funds, you want to invest in that kind of vehicle, then you've got the likes of Vanguard, you've got Hargreaves Lansdown, which you can also use for individual stocks. You can use Invest Engine. They're relatively new, but their DIY offering is very, very good. I did a video on them about 3 or maybe 4 weeks ago. They're really, really good. So you can use those. It really depends on, number one, how you want to invest, what you want to invest in, and what your preferred route is. But there will be links in the bio to this video. You'll find that there will be links to a lot of the ones that I've just mentioned there. Why can't I get the Vanguard Inform Tech shares, and what's the UK alternative? I don't know if you don't tell me what it is. There are some UK, the Vanguard has UK, as their UK website, has their American website. They will have different things on each of their websites because of the way they're built by the company from a regional point of view and offering. So without looking at it, I won't know what the UK alternative is. I wasn't even aware that they had a tech shares. What is it, index fund or ETF? As far as I'm aware, that's not typically how Vanguard actually packages their index funds. They don't have themes, as far as I'm aware. So if they have got a theme, that's completely new to me. So the question I'll be asking you is, are you sure that that's a Vanguard fund? Yeah, because as far as I'm aware, they don't invest in themes in that way. They invest geographically, but they don't invest in specific themes. Do you think financial services providers should have their own sustainability divisions in-house, given TCFD and other disclosures are increasing resuitability? A lot of them do. A lot of them do have their own sustainability divisions. They probably just won't necessarily scream, or you won't necessarily know that they actually have them, but they will be having a look at sustainability massively. A lot of the financial services providers in the investment space are very, very forward thinking. There's stuff that we'd be thinking about now that was on their radar 6 years ago. Ethical investing is a prime example of that. This has been on their radar for a number of years. What's tipped them over the edge in terms of now making sure that they have a tangible offering is the fact that the public has now got on board. Before, it was this idea that it's nice, I can see it, but actually, if I make a fund that is all about ethical, sustainable investing, will the general public want it? That's generally the question that they were asking. They were asking this question 5, 6, 7 years ago. So a lot of them are very, very, very forward thinking in everything because they have teams of people that look at what's the future of investing moving forward. So they will have all of this in-house, and they'll be looking at what's going to be the next big thing in the next 5 to 6 years. That's what they do. That's what investing is all about. It's trying to spot the trends. It's trying to understand what is going to be the next big thing that we can invest money in, that is going to be popular, that is going to earn a return for our shareholders and our customers. That's the whole point of them existing in the first place. So a lot of them will already have it. Any thoughts on the best place to invest in the emergency savings account, keeping it for a rainy day while also growing? Keep up the good work. Yeah, I mean, premium bonds is a good place you can actually put it. You won't get much, but you're going to get something. You might also get entered into the draw to win the weekly prize as well. I had some coaching with someone a couple of weeks ago, and I think he said he won 75 quid 3 weeks in a row. So all of a sudden, that's actually pretty good returns, bearing in mind that you've got that as well. So yeah, bear me 1 second, guys. Bear with me just for 1 second. I'll be back. Sorry, guys. I thought I might be able to fix. I think I know what's going on with the quality of the stream. But I thought I was going to be able to fix it. But yeah, for some reason, I just can't. And it's bugging me because I can see what you're seeing on the other part of my curved screen here. And it's really, really bugging me. And I think it's because I'm also streaming to Facebook at the same time. So yeah, this will be one that I'm going to note just for the comparison and stuff. So yeah. I think there was a follow-up I've just noticed off the back of this question here from Kai, which I'm getting ahead of myself here. Where's the best place to buy premium bonds? If you just go NSNI, Google that, that will take you directly to the NSNI website. You can buy directly there, pretty much. Right, let me just find where I am. Okay. Do you like equities or funds more? I have both. I have a core. I invest based on a core satellite approach. So most of my money is in equities, but funds. So ETFs, index funds, and then I hold individual shares around the periphery and a little bit of crypto as well. What do you think is happening at Prudential with the ABC funds not being updated on their website for the last 9 months? I can't comment because I've not really paid attention to it, mate, if I'm honest. That's not like Pru, though. They're generally really, really good with updating things. I think normally they would update on a quarterly basis. So, that's interesting. But I can't really give a view because I've not really paid attention to that. Coupled assassin. What a name. I love that. Is it true gold coins and in half and full sovereigns are free from capital gains tax, unlike gold bullion, non-UK gold coins? There is an element of them that are free of capital gains. Yes. And half full sovereigns are free from capital gains tax, unlike gold bullion, non-UK gold coins. Yeah, so some of them will be free from capital gains tax, for sure. That's one of the benefits that you will have. But the thing is, if you're buying physical gold, you've got to worry. It's not just capital gains is the last thing you'll be worried about, because if you're buying physical gold, you're buying, gold coins and stuff like that, then, you've got to store these things. And, God forbid, you get broken into, or you have a fire or something like that, and you're holding a good amount of value in that kind of asset in your house. It's, you've got to think about offloading and the ease of being able to get rid of it as well. And you do have a capital gains allowance of 12,300. So are you holding that much? Really? Are you holding that much, or looking to purchase that much gold that is going to trigger you exceeding your capital gains allowance of 12,300? If you're not, then it's all about the convenience and the method of actually investing in these things. What is going to be quick for you to access very quickly and offload very quickly if you needed to? And those are the bigger questions, not how do I start avoiding paying tax on what I hold in gold? You've got 12,300 as a capital gains allowance straight off the bat. Yes, that is distributed across all of your investments, but still, it's quite a bit to have as an allowance. Collar, let's have a look at this. Could you please explain how stop loss work on Etoro? Thank you. Okay, so stop losses. So for example, if you're going to enter into a trade, so again, you're entering into a trade for this. So let's just say you buy Tesla today, and I don't know, what is the Tesla price right now? Let me just check this out 1 second, so I can actually use some real numbers for this. Actually, let me just log into Etoro. Alrighty, let's have a look. So Tesla at this point in time you can buy it at the moment at $782.11. So let's just say you go and buy Tesla right now, okay? And you wanted to put a stop loss on it. Etoro will allow you to put a stop loss on. Basically, what the stop loss basically does is it allows you to say, right, I'm going to buy Tesla at $782.11 right now. I am okay if it goes down to $775, but anything below that, I don't want to continue to make a loss. So what you can basically do with a stop loss is you can set your stop loss at $775, and if the share price of Tesla reaches or breaches that, it will close your position, essentially. So it's there to protect you from massive swings in the share price of any asset that you buy, be that crypto, be that stocks, or anything, essentially. So that's how a stop loss basically works on Etoro. Are you familiar with Portfolio Visualizer? It gives analytics on how diversified you are in each sector, past performance, and drawdown. It's really nice. I know that there are tools like this that will automatically just give you an idea of how diversified you are. They are good things to have a look at, particularly if diversification is on your agenda and it's something that you're concerned about. I said this on the live, I think it was on Sunday, that when you're looking at investment portfolios, diversification is where you kind of make money. It's that careful planning of where you want your money to be exposed to, especially if you're buying individual stocks as well, in terms of how much of your money do you have allocated to each company. That's where your research really matters, and that's typically where it makes the big difference, because if the diversification is right, your performance could be very healthy. If the diversification is wrong, then your performance could actually suffer, because it's all about being as optimized as possible. So there are tools like that. They're really good. I think Simply Wall Street actually have something very similar when you're doing when you put in the stock and it pulls up your information. If you start to build a portfolio with them, it actually tells you what you've got in each sector and the diversification rate as well. I've had a look at many different trading apps. However, whenever I look at the reviews, they're all very bad. How do I know which to go with? I'm currently on the waiting list with Trading 212. Look, every app is going to have bad reviews, because at the end of the day, people will always find something that they find unsatisfactory with a service. And think about it this way. As human beings, we don't typically go around shouting and screaming that, oh my God, this has been amazing. If something's really bad, we will talk, we will speak up. So, I think at the end of the day, what you need to do is you need to have a look at all of the options and all of the platforms that you've been looking at, and just do a simple pros and cons. Most of them are pretty good. I mean, Trading 212 is good, but they're not perfect. I mean, if you look at the reviews on Trading 212, I doubt very, very highly that they're going to have glowing reviews. Very, very high. I doubt it very highly that they're going to have glowing reviews. The question is, how many have you looked at? I mean, there's Trading 212, there's Stake, there's Free Trade, there's Etoro. You've just got to pick one, mate, at the end of the day. And just, you don't worry about reviews as such. You need to worry about whether you think that you're going to be able to get on with the interface that they have, and whether, you like the interface or not. Do you think it's intuitive enough? Those are important things, alongside, obviously, the size of the company, how long they've been going for, all that kind of stuff, and what you can actually invest in. Those things are important, but don't pay too much attention to the reviews, because generally speaking, there will be people who are either unhappy about something because either they had to do some verification that maybe took a little bit too long and they were asking too many questions. You don't know the real reason behind people's grievances. There will be someone there that will be genuine, obviously, that actually they were poor on this, and those things you should obviously bear in mind. But all of these apps are going to have it. All apps have it. All banks have it. All companies have negative reviews. Unless you're finding them with literally all of them really, really, really bad reviews and hardly any good ones, then maybe be a little bit concerned. Okay, I don't know whether this has got a part one, but have I missed something? I'm just having a look. One sec. I don't think I have. It's totally different to the Google prices, and my smaller holdings are the same as Google, or 1 or 2 pips difference. Seems like they're manipulating the stock price for me. I can't even comment. I can't see it, so I don't have any context. I don't have anything to reference it to, so I can't say. Yeah, well, you know what, Roy? That is very, very true. See, being a United fan is, oh my God, it's 2-1. Oh, we actually won. Thank God. Okay, this is good. This has made my evening. That's a good result. Hang on, I just need to check this. Who got the winner? Ronaldo got the winner in extra time. It couldn't be anybody else but him. Hey, this is good news. Look, Ollie would have been in trouble if he had lost this match tonight. He would have been in real trouble. And to have a squad with that many players of pretty good caliber, and to be struggling and lose to Aston Villa is just it's nuts. It's absolutely nuts. But they did win tonight. They scraped through. So I guess Ollie has a little bit more rope. But yeah, they're not losing like City did last night to PSG. But then again, we weren't playing the likes of PSG. I think if we came up against PSG yesterday, we probably would have been run over. But City played really, really well, to be fair. They did play really, really well. But that Messi goal was insane. Absolutely insane. What are your views on the Evergrand dump in China and US USD deflation scenario? Listen, the Evergrand, listen. Oh my God, listen. It's one of those situations where if you look at, there isn't going to be a contagion as a result of the Evergrand dump. It won't impact developed or efficient markets too much. There will be an impact, but not loads, unless there's been some really unscrupulous kind of practices that have been happening in the background where companies have got way more exposure than they ever should have had. As long as that doesn't happen, there isn't going to be a huge kind of like contagion that will impact like the markets like Lehman Brothers in 2007, 2008. I'm more interested to see what is going to happen, whether the Chinese government will kind of like change tack and actually bail them out, or whether they'll stick to their guns and just let the company just go bust, because that looks like what is going to happen. It just amazes me that you can be worth 2 billion or 3 odd billion or so, or 20 odd billion, I think it was, that they were worth, and have $300 billion in debt. It's mad. It's way over leveraged. And a lot of the big investment houses would have seen this coming. And I know of one that dumped their position last year, apparently. And even when I was working for an investment house, whenever we had a look at or a conversation around China and investing in China, people always approach China with trepidation and skepticism, because you never really were clear or confident in the data that you were getting out of China. So the investments were scrutinized really, really closely. And the choices in terms of where they were invested were made very, very cautiously. So for those reasons, I don't think there'll be a lot of like contagion moving forward. In terms of the USD deflation scenario, it'll be interesting to see what happens. I think there will be continued QE. At least that's what Ray Dalio has been talking about today. And look, there's a lot of stuff going on in the States right now. I mean, Biden, Jesus Christ. I mean, he's up against it. I mean, for all of the optimism that people had in January, I got to say, the Democrats, they just don't know how to fight dirty. And the Republicans are just great at that. And they're pulling all kinds of levers. And his popularity is just absolutely shot. Really, really is. There are people, talking about the fact that Jerome Powell, the head of the Fed, needs to be, ousted at some point. It's crazy what's going on out there at the moment. So I think deflation scenario, who knows? I mean, there are a lot of, Kathy Woods is saying that, for the next 3 to 4, 5 years, we're going to be seeing deflation. And that's going to be driven by the fact that, it's going to be technology driven. But who knows? We don't really know. What we do know is if they do continue QE, that's obviously going to impact on the markets. And obviously the markets will always do what they do. But at the same time, you will know for a fact that they will continue to do everything possible to ensure that their market doesn't take an unnecessary dive without the relevant interventions like QE. And I think they've been very, very diligent in making sure that they took all the necessary steps through the pandemic. There's a huge, huge debt issue as well, which underpins all of this as well. So that's another can of worms that keeps being kicked down the road over and over and over and over again. And the plans for spending that they have, the infrastructure plans, are huge, which is going to inflate that debt bubble even more. So it's going to be interesting to see what basically happens, but who knows? Right, follow up. Looking to invest long-term 10 years plus, which index fund should I invest in? I can't tell you which index fund to invest in, mate. Okay. I can't tell you a specific one to go and invest in. I don't know your full situation. You're talking 10 years, which is great in terms of term. That's fine. I don't know where you are on the risk spectrum. The best thing that you could do is, depending on who you're looking to use, think globally. I can tell you that, but I cannot tell you the specific index fund to go and invest in. It's impossible. I don't know enough about you to be able to do that live on YouTube. It would be irresponsible of me to do that. If I sell some shares, will that figure on the screen at the time be the selling amount, or does the share sell at the amount it is at the end of the day? It should be the amount that you get on the screen, but it does depend on how quickly they're able to execute that trade. So it should be what you see on the screen, but it depends on whether they take a little bit of time to process it or not. And that is assuming you're holding individual shares, by the way, and you're not talking about an index fund, because an index fund, you can't close until the end of the day. Okay, I don't know if this is a comment for me or just a question for me or just a general comment, but let's get this up anyway. Put everything into a flat deposit, excluding emergency fund, as per put some into deposit and invest the rest. I get point on mortgage rate X versus. Okay, I don't know what what that means. I think that's a comment. I have stake in free trade, still waiting for trading 212 to open up so I can use their free ISA. Yeah. Yeah, because trading 212, their charge, I think it's like £3 a month or something like that. And stake don't have an ISA right now. So yeah, I mean, look, you could be waiting on trading 212 for a very long time, mate. So my advice to you is go find another provider, really, because they haven't been opening accounts this entire year. That's 9 months. We're 9 months in waiting. So you're going to wait until next year. You're going to wait in for another 18 months if they decide not to open accounts anymore. Don't wait for providers. Just because something is free, I get it. I get the attraction to it. But why don't you just go and open a Vanguard ISA? Or why don't you just go and open a Hargreaves Lansdown ISA? Those are free. Why don't you go and open an ISA with Moneybox? That's completely free. So, you're going to have fees for the investments, like you'll pay spreads on the stocks that you're buying and the trades that you're placing on trading 212. So you're paying in one way, but don't wait for trading 212 because you're cheating yourself of being able to invest in the market, really. Best platform for individual stocks with the cheapest fee/spread. I've already mentioned a few of these. You can have a look at eToro's. I don't know about spreads. You'll have to do that work on your own, unfortunately. But Free Trade, eToro, Stake, Orca, those are just 4 that you can have a look at. Although Free Trade do have a free account, but they do have the ISA you have to pay for. It's just like it's £3 a month. And guys, like, come on, like, stop going for free options and thinking that is the way you select your provider. That's not how you should be selecting your provider. Like, seriously, because it's free doesn't mean it's the best thing that you should go into. It doesn't mean it's going to give you the value that you're looking for. Like, £3 a month is 36 quid a year. I know that is a lot if you're only starting out with small amounts of money, but think about the fact that if you didn't use an ISA and you went for a free provider and you grow 10%, you're going to pay tax on that anyway. You're going to pay 20%. And it does depend on how much you invest in. But don't just look at providers and think, oh, I'm going to use the free one first. That's not how to select a provider. It really, really isn't. I don't know. I really don't know. If I had a crystal ball, I'll be able to tell you, but I can't. The markets are volatile right now. Does that mean they're going to crash tomorrow? I have no idea. The markets might continue to rise for the next 6 months. I have no idea if that's going to be the case or not. So I don't have a crystal ball, unfortunately. Pete, I heard it's cheaper to buy Vanguard S&P 500 ETF through Trading 212 than it is to buy off the Vanguard website. Surely not. I don't think that will be true at all, because on Trading 212 can't get round how much Vanguard charge for the ETF. So it's not going to be cheaper. They're not going to get it at a discount because that's not the game that Vanguard are in. They build the ETF, so it is their fees. They're not going to negotiate with any provider to have it on their platform at a discounted rate. Why would they cut their nose off? Like, you go to the source. It makes no sense whatsoever. So definitely not. I know that's definitely not true in Trading 212, unless it's a different variation of the Vanguard S&P, because the likes of BlackRock do have an S&P 500. Fidelity will have one as well. So you might have the iShares S&P 500 or something like that. That might be a little bit cheaper, but it won't be the Vanguard one. This is a good one. If you've had them, you would have had notifications, Brian. because they normally notify you. If you won anything in the weekly draw, they send you like an email, so you would have known that you've won something. Unless you've got like an old email address or something, you would probably have to pick up the phone to them and just and make sure. But then again, you must be checking your balances, right? Because anything that you win gets added to your balances, so you would know if you won something for sure. There's let me just come to this one. Look, I don't know about this, mate. Like, I've worked in the industry where analysts look at information from various sources. And when these analysts look at information, it comes from sitting down on the boards of companies. If there are conspiracy theories, what are these conspiracy theories? Like, do you think it's a conspiracy theory that a company is going to default on $300 billion worth of capital? For what reason? And plunge almost 4 million people at risk of a job? Like, the investment world is no place for conspiracy theories, mate. And a lot of the time, investment decisions are not made on conspiracy theories. It's based on research that is done, and as much research that they can do from verifiable sources. And a lot of the time, these investment houses, when they invest money into a company, they seek to sit down with the CEOs of these businesses and sit on the board of these businesses, because they are offering a billion, 2 billion, 900 million real money. And because they are custodians of their clients' money, they want to see the whites of people's eyes, and they want to turn over the accountant's book to see that the numbers are verifiable. That's how they make investment decisions in the investment world. When you start looking at the providers like Vanguard and investment houses and investment managers, they rely on that information. In the case of China, sometimes they wouldn't be able to get those meetings. They wouldn't be able to verify some of the numbers that are coming out, which is why they'll be like, actually, look, we're getting some information, which is fine, but there's a lot of information that we are asking for that we're not getting, and therefore that influences the investment decisions that they make, and whether they do or not, whether they do or invest or not. If we're talking conspiracy theories about, Evergrand, and I don't know what these conspiracy theories are, I don't pay attention to that, because at the end of the day, the investment industry are way ahead of the curve of most retail investors, and probably ahead of the curve of what most news outlets will have access to as well, because they will be in the process of researching companies. Companies, to get added to an investment list, get researched sometimes for 2-3 years before they actually get added to an investment list. It takes that long sometimes for a company to get added. It's not an overnight thing or a week thing. There is real work. People are paid very, very handsomely to ensure that they get as much information so that these companies can make the best decisions possible. Because at the end of the day, they are custodians of people's money. The last thing that any investment house wants to do is lose money for their customers. That's the worst thing that they want to do, because it affects their reputation. It affects their profits, more importantly to them, and it also affects their customers. So that trifecta is one thing that these investment houses absolutely detest facing. It's one of the rules. Like Warren Buffett says, don't lose money. They don't like losing money, and they try to do everything possible to ensure that they don't. So they don't listen to conspiracy theories, and I wouldn't believe it, and I haven't really paid that much attention to the conspiracy theory. Where's the best place to research things like upcoming contracts companies are hoping to get, or just other information sources about companies that would impact stock price? You wouldn't be able to get access to that as a retail investor. You just won't. You will not get it because it is stock price sensitive. The investment houses will get access to it, and they may not get exclusive or explicit news of, by the way, we are signing a contract. But if they are invested in a company already, where they are shareholders and they're sitting on the board, they will know that information. But they're already shareholders at that point, so they already have money on the table. They probably won't get it as an investment company if they don't have any financial interest. you won't get it as a retail investor. You just won't. It won't be available in the public domain. It just won't. And there are rules specifically around contracts that or changes to a company that could impact the stock price. The first people that they tell are the shareholders, the existing shareholders. Then it goes out to news. And by the time you've heard it on the news, it's already too late. These are rumors, mate. I mean, if it does happen, I don't think it will, because, I mean, look, the inflation number at this point in time for the UK, they're saying it's going to be 4% by the end of the year. And I can see that happening because the cost of supply chain producing things, that has to be passed on. And that's going to be passed on in the way of inflation. So these are rumors at the moment. It'll be interesting to see how things change for that to be a scenario. But at this point, I don't know, mate. Do you have more access to information when you're in Canary Wharf, or can you access everything through the internet nowadays? The information that the investment houses and the investment managers and all these big companies like Vanguard will have access to is not available on the internet. By the time it hits the internet, it's way too late. We get highly confidential information, and we will get that down on a daily basis. That would form the decisions that professional investment managers make. And a lot of the time, when you get the news when you get news or wind of the news in the media, all the changes have already happened with pre-market trading is already priced in. So the information that we will get in as in an investment house and in Canary Wharf, you would not find on the internet. Literally, put it this way. What you hear on the news, if it did come out on the financial news, the investment houses and fund managers probably would have heard about it hours, if not days before it came out on the news. So they are way ahead of the curve, way, way, way ahead of the curve. Why? Because they have large pools of money, and they are professional companies representing a lot of people, and therefore they demand access to the information because of the pools of money that they control. See, okay, so look, it doesn't matter who you use. There are going to be fees involved. Like, I know that free trade and like trading 212, like they came out and they really did change the game when it comes to this whole free to invest, free trading thing, right? They did a great job at that. But don't be fooled. Running an investment business is extremely expensive, and companies are not going to foot the bill for you trading or buying a US stock. The companies are not going to cover that cost. You have to cover that cost. It's like basically going into like Tesco's, picking something off the shelf and saying, yeah, Tesco's, why don't you pay for this? No. They built the store for you to come in and buy something. You're going to pay their prices, which is going to include their spread, and it is going to include any currency exchange fee. It's not their job to cover that fee for you. So yes, it is going to be expensive. But again, if you're trying to look at something that is going to be the cheapest, okay, let me put it this way. If you could pay 0 FX fees, but then you place a trade and it takes 2 hours to complete, is that okay? Because in 2 hours, if you wanted to buy something at, say, £1, in 2 hours, it might go up to 150. Are you happy for that investment difference simply because you want to make the process of buying it cheaper for you? It is really expensive to run an investment business, extremely expensive. Just the licenses alone are crazy. The teams, the compliance, everything that they have in the background, extremely expensive. They have to pass the cost down in some way. And even if you look at Trading 212 now, they have started to introduce little nuggets, little fees here and there, because it's only for a certain amount of time that you can continue to provide a free service before it becomes completely unsustainable. Just a matter of time. So don't, FX fees are there. They're there to facilitate the exchange of currency. The fees are not dictated by a lot of these platforms. These fees are standard, and they may want to have a little bit of a margin on them. Some of them may not even take a margin on it. It's just it's the cost of doing business, is the cost of trading. But you can, by all means, compare free trade and stake and Etoro and see which is the cheapest one. But at the same time, just remember alongside the fees, it's all about the service that you're getting as well. Speed of execution, how easy it is to close positions, the interface, how well you get on with that, how it actually enhances your experience of actually investing. If you're using like Etoro literally just refreshed their interface like a couple of days ago. It's much, much better now. But one of the things that used to frustrate me with Etoro was when you're trading on, or you open a trade on your phone, if you don't turn it this way, you can't close the trade. I learned that the hard way. But it's simple things like that that are just like lunacy. And it used to drive me nuts for a week. And I finally figured it out. I was like, okay, I need to rotate it this way in order to close the trade. Simple interface problem. But those things are really, really important. Thank you for this super chat. I really, really do appreciate it, AA. Let's have a look. I had 27K in my ISA since last year, but over the year saw 0% increase, tech funds, and just added another 20K into S&P 500. Is that sensible? So you had 27K in an ISA since last year and you've had 0 increase. What are you invested in? You would have seen an increase, surely. I mean, what are you in, index funds, or you are in individual stocks? What exactly are you invested in? Because if you're in the top tech stocks, you would have seen an increase, and any tech ETF or index fund would have seen an increase over the last year for sure. So I'd love to know what you're invested in, but if you've got another 20K into the S&P 500, is it sensible? In the sense that you're paying into your ISA and maximizing your allowance? Absolutely. Absolutely. The S&P 500 is a good place to be. It is the top 500 companies in the world. So yeah, it does make sense that you've done that. I would be asking though, and the bigger concern for me is why you've had no increase in the tech funds that you're invested in over the last 12 months. I would suggest that you need to review that, really, to be honest. But thank you for the super chat. If you had 100K to invest, is it better to feed 20K for the next 5 years into a tax-free ISA, or put a large sum knowing that there would be tax implications? The best thing for you to do is to put 20K into your ISA the first year, and then general investment account the remainder, and feed it into your ISA every tax year from there. That's what I used to do as a financial advisor. You don't want to feed it in every single year, then miss out on any potential market growth. Yes, you're going to have to pay tax potentially. Again, you're going to have capital gains allowance that you would need to breach, which you might with 80K left over once you deposit your first 20K. But if you've got to pay tax, you've got to pay tax. At least you've made more money in order to make tax. So yeah, 20K into your ISA, 80K general investment account. Then when the new tax year rolls around each year, you siphon off 20K into your ISAs for the new tax year. No worries, Brian. Thanks for the premium bond answer. The ticket is pretty old. Worn brown paper, probably older than 30 years, but the ID numbers are visible. Keep up the great work. Cheers, mate. Yeah, I'll literally just, mate, if you've had it in there for that long, you've probably done really, really well, to be fair. So, mate, listen, good luck with it. It'll be interesting to see what you've got in there now. Yeah, and they're going to, mate, because at the end of the day, they are not going to, they're not going to sustain like allowing millions of people to invest for free. Like, they're not going to do that. And this is, many people will argue this is, really poor business. They've roped people in. No, like, that was their offering, and now they've got to scale. And to be honest, it's probably cost them money to be able to get people in at the volumes. People were saying that the business was profitable before January, before they stopped taking accounts. Well, now they're going to be even more profitable because they are going to start introducing little charges. They're a business at the end of the day. They're not there for people to use the facilities for free. That's not how they make money. That's the business is not going to be sustainable if they continue to do that. So it is what it is at the end of the day. They are a business. All right, cool. That is everything. Thank you guys for watching this and joining me for this one. A good number of likes on here as well. Yeah, video on Friday. We might do this again on Sunday. I'm paying attention to a lot of the financial news at the moment, so I might have a little bit more commentary on what's going on at the moment. But yeah, tomorrow's going to be an interesting day in the States. I'm sure they're going to, approve whatever they need to tomorrow, and it's their deadline day. But the Republicans are obviously at war with the Democrats, and the Republicans know how to politic. Let's put it that way. But Joe Biden isn't really helping himself one little bit, which is even making me review, and I need to review my cannabis stocks even more because, oh my God, it's not good at all. But yeah, guys, appreciate it. Whatever you're doing for the rest of the week, make sure that you take care of yourselves. Have a great time. I'll catch you on Friday.